Welcome everyone, and thank you for joining the CFA Society Switzerland's webinar on the test of a crisis. Core infrastructure is essential. We'd like to give many thanks to our sponsor, JP Morgan Asset Management. As we go through the presentation, please use the Q&A symbol to ask questions. After the presentation, these questions will be addressed by the speakers. And now, for the moderation of the webinar, I will hand over to Richard Nell, CFA, a member of the CFA Society Switzerland and a client advisor covering institutional clients at JP Morgan Asset Management, based here in Switzerland. Welcome, Richard.
Thank you very much, Sheila, for the introduction. And also from my side, a very warm welcome to everyone to today's webinar. Obviously, I would have preferred to see you all at the Swiss Pension Conference this year, either in Geneva or in Zurich, as in the last years. But as we know, it is unfortunately impossible this year. But nevertheless, I'm very pleased to be joined today by two of my colleagues to discuss first recent development in the financial markets, and then to have a focus on an asset class that has been increasingly important for Swiss pension funds, namely in the infrastructure space, with a particular focus on the core space. Looking at the agenda, the first part will be presented by Tilmann, who is a senior global market strategist at JP Morgan Asset Management, responsible for providing some insights on the global economies and global financial markets for institutional and retail client base in Switzerland, in Germany, and in Austria. Some of you maybe have seen him already, as he's several times per year in Switzerland for this market outlook session. So we will talk about recent developments in the markets with evaluations, and then also the recent monetary and fiscal policies. What are the consequences? How far can we go? And also two topics that are very important today. It's the trade tensions between the US and China, and also the US election that is coming in the next weeks. And then the second part on infrastructure core, it will be presented by Daniel Galinko. He's an investment specialist in our infrastructure investment group based in Zurich, based in New York, sorry. So for him, it's early in the morning, but thank Dan for waking up so early and being here for discussing this very interesting asset class. And first, he will discuss the impact of COVID-19 to date, and then how we did some action in our portfolio management during the crisis, and then also what will be the outlook for the asset class in the next month or years. But prior to that, I will first start with Tilmann, with the market outlook. So we have seen that since the beginning of the year, many things happened. There was a big crash in March in the equity markets. And what can you tell us about the most recent numbers, the most recent infos you can share with us about COVID-19 and how it affects the global economy?
Thank you very much, Richard. Yes, indeed, we are living in unprecedented times. As we can see as of now, that we are all connected via a webinar and not attending a live conference. And a lot of things also that happened on the market are differently than we experienced in previous market downturns. And finally, when you look at the economy in previous recessions. And Richard just pointed out, we had it in the second quarter, a sharp downturn in the market. We saw probably, end of first quarter as well, we saw probably the fastest decline from an all-time high in recent history. But since March 23rd, we saw also a very swift and quick recovery. Never before recovered markets so fast, particularly on the equity side, than in this cycle. And a few weeks ago, we just marked also a new all-time high. which raises the question now that the all-time high is marked in a recession, do equity markets kind of really lost the connection to the reality? Is this what we are experiencing really real? Do fundamentals still matter? Or is this probably kind of a giant risky bubble that is creating? And this is kind of the key question that I want to try to answer in the next 15 minutes. And related to this also, kind of the most important question then investors need to ask right now, what do I need to pay attention to? And for us, it's in the end, three things. It's policy, policy, policy. It's what's happening going forward with monetary policy, what's happening with fiscal policy. And in the end of the day, when we look to November, or when we look to the recent developments between the US and China, what are the risks on politics? Because despite kind of this new optimism that is coming into the economy, that is coming into the markets, that you can see on the slide on the right-hand side, with purchasing manager indices that are recovering fast, that are now at a pretty similar level like before the crisis. We should not forget that we still have a health crisis that is not solved. We still haven't found a medical solution to the COVID-19 crisis. We are probably moving closer to it, but the infection rates are still very high. And we should acknowledge that kind of the recovery we've seen, looking at the economy, but particularly at the market, is probably at the mercy of the policymakers who moved a lot of money to kind of mitigate the negative effects of the crisis. So let's start with a look at the equity markets on the next slide. If they really kind of disconnected from reality. Kind of on the right-hand side, you can see on a regional basis how equity markets performed from the sharp correction from the low March 23rd. And it can be seen that not all equity markets performed in the same way. That we have kind of two clear outperformance in the equity world, and this is the US and emerging markets, but emerging markets particular, Greater China and Korea. Those markets kind of really made kind of a V-shaped recovery, while with other markets there was a swift initial recovery, but then kind of the dynamics died down. Kind of this recovery is more of an incomplete one. And this is, in my view, still kind of mirrored by the fundamentals. When you look at the left-hand side, you can see how the earnings expectations developed. And that indeed, those markets could outperform which had the most resilient earnings, which had the least negative earnings revisions, that were less hard hit by the crisis than other markets. So on the relative
Tilmann, you mentioned about the different equity markets, but what about the sectors? Because now we are in an all-time high, but I guess there are some very big difference between the sectors, and there are big winners and big losers. Can you explain a bit more about that?
That's a great question. Thanks, Usha. Yeah, and indeed, you can see this not only on a regional basis, but only on a sector basis. And this has sometimes the same cause. It's caused by the health crisis, it's caused by the Corona crisis. And the markets indeed kind of differentiated significantly between the winners of the crisis and the losing industries of the crisis. We try to put an aggregate together that you can see on the left-hand side with the S&P 500 industries that kind of differentiated between between the industries which are less affected or which even benefit from the changes of the COVID crisis, from the lockdown measures, from the changing in consumer behaviors, and other industries that are hit very hard because of lockdown measures. And so we put two aggregates together, the so-called stay-at-home industries. Those are industries like IT services, pharma, interactive media and services, internet, direct marketing, retail. Those are the industries that kind of benefit from the change in consumer and daily living behavior of the people. And on the other hand, you have kind of the losing, the going out sectors like energy, banks, hotels, restaurant and leisure, aerospace. Those are especially hard hit. And you see that how this kind of differentiation is taking place. That indeed kind of the market differentiates between the two industries, and not everybody in every sector is going up. And on the right-hand side, you see kind of the sensitivities. Now that sometimes also this valuation gap has become very large, you might ask, when will these kind of elevated valuations from the stay-at-home stocks that are usually most in the growth sector, when will kind of this valuation spread that has built to the value sectors, when will this valuation gap narrow? And then I think we are getting close to the situation with the health crisis. As soon as the health crisis is not solved, as soon we still have these lockdown and social distancing measures in the economy, until a medical solution is found, there will, in our view, be no lasting kind of normalization and narrowing of the valuation gap. So this gap we are seeing regarding between growth stocks and value stocks are likely to persist as long as the health crisis persists as well. And those absolute valuations, when we look at the next chart, are also kind of supported with a monetary policy that is very expansionary. And this is also something that favors the growth stocks. Growth stocks are long duration assets. So if the discount rate, the risk-free rate is very low. And in developed markets now, when we look at the left-hand side, you see the long journey to zero has finally almost come to an end. The average policy rate in the developed markets of 13 central banks is now at 8 basis points. So when this risk-free rate is that low, long duration assets with that discount rate have kind of an valuation support. But it's also kind of markets, and equity markets are supported by this enormous liquidity support that we are seeing. And this is what's different to the financial crisis. I know this time it's different is a very dangerous sentence to say and can be very expensive for investors. But on the right-hand side, you can see what I mean. This is kind of comparing how the yields in the financial crisis developed after the equity market low, when markets started to anticipate the recovery in the economy, when the technicals deteriorated for the fixed income market because of those large rescue packages at that time. This time it's different. Central banks jumped right into the market. All the tools were tested in the financial crisis before, and they initially kind of supported the market and kept financing costs and yield low and provided an unprecedented amount of liquidity to market. And so now is the question, when will this kind of a punch bowl will be pulled away? And this is what I mentioned at the beginning, kind of a risk probably for the markets and equity valuations if policy support disappears. Now we've learned in Jackson Hole from the Fed with a new framework, with a new monetary framework of inflation averaging, that probably the central banks are a less risk of withdrawing support, because what does this inflation averaging do to monetary policy? It changes the reaction function. It gets not a proactive, coincidental policy tool to find inflation. Now with this average inflation target, it gets a lagging indicator, because central banks are willing to accept a certain amount of inflation over the target, because previous years, we were below. So from that point of view, central banks are very likely to stay very expansionary going forward. On the next slide, we see more of a kind of a risk we should monitor probably more closely, and that's the fiscal support. I mentioned briefly that in this crisis, the fiscal support is unprecedented. It's larger than all of the fiscal support we've seen in the financial crisis. In particular, in the US, we see a very large stimulus going into the market. And this is kind of the risk I want to highlight. The fiscal support is kind of preventing the economy from collapsing, is preventing this kind of vicious cycle we usually see in a recession. And this you can see on the left-hand side. This is the consumer confidence in the US. And in this crisis, despite those horrendous GDP numbers, confidence never reached the lows of the previous recessions in 2002 and in 2008, 2009, because kind of the governments intervened immediately and supported private households with a lot of money. But at the end of the day, this is the risk. If they withdraw these stimulus measures, and you can see currently in the House and the Senate, the discussion and the dispute about what to do with the unemployment insurance. Will this get kind of extended? Now that those insurance payments ran out, you always can see the first wobbles in confidence. So this is indeed a risk going forward for the market, that in the end, fiscal policy will and have to withdraw from their unprecedented levels. When we move to the next slide, you can see the consequences of this for another sector of the market, for the currency market. And this is kind of the limitation of all this huge support we are seeing from the central banks and from the governments. This is how much will this probably debase the currency? When it gets so large and too much that it's probably the risks the stability of the currency. And you already see some first consequences on the currency market, that the support for the dollar is going down. The interest differential went down significantly between the US dollar and the rest of the developed markets, but also kind of the outlook of rising debt levels in the US that already led to kind of a negative rating outlook watch from the rating agency is a risk to be monitored. And so kind of the year-long dollar strength is undermined by the recent policies we've seen. When we move to the next...
Tilmann, if
yep.
I can ask you a quick question here. So what do you think, we are here in Switzerland, what do you think about the Swiss franc against the dollar and other currency? How do you think it will develop, and will that help the Swiss franc to get strengther, or what's your view on that?
Well, the Swiss franc is there on the other side. The dollar, we see the dollar strength waning. So from that point of view, the Swiss franc is in our view likely to get stronger. And even in the relationship to the euro, it's a kind of a mixed picture. We have now with a new next generation EU fiscal package, we have kind of a less breakup risk in the EU, but in the short term, we still have the Brexit risk that keeps at least the demand for the Swiss franc high. From their point of view, we see the Swiss franc still a bit stronger. When we look at other political risk, it's the risk with China. Recently, the discussion about the trade deal and probably that China is currently not in compliance with the phase 1 trade deal that was made in February raised kind of the outlook and probably the idea in the market that there could be a trade conflict, a renewed trade conflict between the US and China around the corner. We see this risk still more as limited because it would definitely be a big volatility creator for the market. And I'm not sure if the US president currently is willing to risk equity market turmoil just before the election, particularly if he views the equity market and the equity market performance as one of his assets of his presidency. When we move to the next slide, and then we were already at the election, I think the US election will probably heavily be influenced by how the health situation is further progressing. We could see that that the approval ratings from Trump suffered when the health crisis erupted. But it's still a way to go until November, so a lot of things can happen on the medical side as well. And we could see that now that the infection rates are going down in the US, that the approval rates of Trump are increasing. Looking at the markets, I think we should generally, at the next slide, be cautious to make a directional call on the elections. Of course, we see that President Biden will probably and wants to raise taxes, which is per se probably more a negative for the markets. But you should see this in perspective, that Biden also wants to spend a large infrastructure package of $2 trillion US. So so from that point of view, this is also something that could be supportive for markets. When we move then to the...
So yeah, Tilmann, so after all you have said, what would you say are the main opportunities that we're seeing or that we're expecting in the future with all those uncertainties that we have currently in the markets?
I think when we move to the next slide, I think it's helpful just because we have so many short-term events not to forget about the long-term picture. And there, I think our long-term capital market assumptions that we release every November, and we're currently working on the new one, are a helpful guide. Where are still kind of the return opportunities and where are less return opportunities going forward? And now I think it happens to be that now with the recent equity markets recovery, we're pretty close to the September levels last year that went into our model. So the return assumptions we can see on the right-hand side of this slide, so the 10-year long-term per annum return assumptions in US dollar, we can see that there's still, despite higher valuations, still return opportunities for the investors left. But we can also say that on the left-hand side of this side of the chart, things are going in the wrong directions for investors. So the yields haven't recovered after the crisis and are still at very depressed levels. And now, as I mentioned before, with the inflation averaging, the interest normalization path going forward will be much more further in the future. So from that point of view, the return assumptions, the long-term return assumption for fixed income, for high quality fixed income, will further go down. And it will be at a level where investors can't reach their return goals with fixed income. The real returns are very likely to be negative for the time being. So at the end of the day, traditional fixed income and the high quality area have more a part of risk management in the portfolio than for return management. So investors need to look out for ways, how can we get returns and still risk premia in the market that also helps to reduce the risk in the portfolio like traditionally fixed income was able to do. And there we go to the infrastructure part and to the alternative parts that you see with the gray bars, where you still see a lot of compelling opportunities. And I think that's the last and best sentence to hand over to Dan in New York, who will introduce you into our infrastructure capability. Thank you from my side.
Thank you very much, Tilmann, for the very good insights about what's happening right now and for the help to have a nice transition. So now, Dan, I'm moving over to you. So we have seen really an increased interest from Swiss pension funds for this asset class. So here in Switzerland, for instance, for us, we now have more than 20 Swiss pension funds that are invested with us, and many others are regularly asking us more and more questions about this asset class because they have more interest there. So first, I just want you to give the audience a bit of the feel about what we were talking about. So the infrastructure core, what are the main characteristics and how do we define that asset class?
Thank you very much, Richard. And thank you, Tilmann. That was a wonderful setup in terms of I guess, setting the picture for the overall market environment and why infrastructure is standing out. Obviously, there's just picking up some of the things he said. I mean, obviously, we've got bumpy markets until the medical situation is fixed and there could be more of a wholesome recovery. We have central banks allowing for more inflation, which could bring higher inflation over the midterm. Obviously, fiscal support for infrastructure and just general fiscal support in markets creates all kinds of opportunities or risks or things to consider as you're allocating and considering portfolio construction. So it's a very nice setup. Let me also just say quickly, thank you to the CFA Society for hosting this. Appreciate, and no, not based in Zurich yet, although I'm certainly missing my visits. So I do look forward to the day that I'll be able to travel over and spend time in person again. But yeah, so as we go through, obviously, we'll start with a bit of a basic slide here. Infrastructure is an asset class that really has a whole diversity of risk return profiles. It's only been a private market asset class for 15, maybe 20 years. It's relatively young overall, as investors have participated in. Obviously, it's been around a lot longer through public investments in utilities and other critical infrastructure. Notwithstanding, as we learn more about the space and more data is available, we learn more about the boundary lines between what makes a core plus, value add, opportunistic investment. And I think it is indeed a crisis period like we're in that reveals a little bit more about the true attributes of the assets in the asset class. From our perspective, when you're talking about a core or core plus asset, it really should at its fundamental basis have a predictability of income. The return should be predicated on that income as opposed to a capital appreciation. And certainly there's assets in our asset class that have more value added or opportunistic profiles based on underlying risk profile or counterparty contracts, et cetera. So again, from our perspective, we're very focused on core and core plus markets. And as we go through, we'll talk more about what makes a core asset. On this slide, obviously, we're looking at a few different subsectors here that are delivering a set of returns, which you see on the bottom of the slide. And in our view, what should a core infrastructure asset do? It should provide diversification or non-correlation to public markets or to the other asset classes. It should have indeed that inflation hedge through the contractual regulatory frameworks. And again, cash yield is really at the center. So a business should have a very high EBITDA margin and be able to have a predictability of income, including through these crisis periods. So as you look at the assets at the top of the page, a utility, long-term contracted asset, such as a power generation facility, certainly you have the regulatory and contractual frameworks that you're providing an essential service that's needed regardless of what's going on in the market or what's going on in terms of health crises. Even as people moved home to work from home, as I'm obviously doing now, you need essential electric services, water services, energy. Broadband internet has obviously become more important, albeit not something that we focus on from an investment standpoint. But again, it's these types of assets that deliver the returns that you see on the bottom of the page. And with a proper portfolio construction, we believe you should be able to deliver a return, including through the market environment that we're currently experiencing, that's consistent with those objectives.
And that's like the theory. So what have you seen in the last month since the beginning of the crisis? What have you seen? Some drop in demand, some people that couldn't pay their bills, or what was the situation?
Yeah, absolutely. So that's a good lead into the next slide. And so really when we're thinking about this, what is the risk to the asset class? Data is at a premium. So we need to be able to look at the data to evaluate demand profile or what's changing over time. So I think this is an interesting schematic here. This is some early data from the spring as we got into the COVID crisis. And we're showing electricity consumption. And clearly there was a dip as industrial activity slowed or the lockdowns really went into effect and manufacturing slowed, et cetera. Obviously, Italy had a deep crisis during the height of the pandemic there. But notwithstanding, there is a pretty strong recovery in terms of overall volume, and the decline in demand is obviously something we think that will be shorter lived. People continue to need to use electricity services. And the other piece of that question there is, will people continue to be able to pay their bills? Sitting behind our revenues, owning a utility is a family paying a bill. And so actually, I think that's what is interesting about the right side of the chart. We see over time that the share of overall household spending on utility services has declined pretty substantially as share of wallet. So we see, and our lived experience so far in this crisis is that clients, customers are continuing to pay their bills for essential services. The cell phone bill is still much more expensive than the average electric or water bill. And the cell phone bills are still being paid. People need their access and communication during lockdown phase, but equally so, the consistency of service. So we've really not seen an acceleration in bad debts within our utility complex. And I do think it is a function of again, the essential nature of the services and the fact that the cost of keeping those services online is relatively low relative to historic levels. Now,
you spoke about those two utilities and electricity and the households, but then obviously in the crisis we have seen that the sectors who suffer the most were the airports, the seaport. What can you say about that? And isn't that kind of a big risk for the asset class?
Well, yeah, and so as I mentioned, we're relatively young as a private asset class, and I do think that there's been learnings over time for this sector. So infrastructure, it's tempting to think that all assets are a coupon that pays out, buy it and collect the dividends every quarter. But really, you can see as you go subsector to subsector that there is a differentiation in terms of overall correlation to broader market conditions. So I think this is where a little bit more time before and after a crisis gives rise to some interesting comparisons and data that you could look at to show what is the true volatility in earnings that you see in different types of assets and indeed different types of infrastructure assets. So this is a schematic showing the demand 2 years before and 2 years after the GFC and the trough in markets in 2009. And what you see from this is that things like natural gas, so general energy consumption, electric consumption, were relatively within a relatively narrow band over that time period. Obviously, we have the vehicle miles traveled, but things like airports, as Richard mentioned, seaports had substantial swings in overall volume. So Now, that's not to say that these types of assets aren't necessarily having a home in an infrastructure portfolio. However, we do need to look at the risk profile and think about proper portfolio construction to make sure that the overall portfolio is delivering what we would classically imagine as a core infrastructure return and high cash yields. So as we think about the crisis that we're in right now and how will this chart look when we were able to update it in a couple of years for COVID, what's interesting is that the seaports and the airports have had a bit of a role reversal in this crisis. For very good reason. Supply chains have needed to stay open. We're home, we're ordering things, we're needing consumable goods and services. So the ports haven't been as bad. Airports obviously need to remain shuttered for international travel in large parts of the world. So the passenger volumes could be more impacted for airports, but notwithstanding, obviously, more detail to go into on those particular subsectors and how they've navigated, but it's important, again, to think about portfolio construction and the types of assets we're including in core infrastructure portfolios.
And also a core characteristic of infrastructure core is really this non-correlation with the financial markets. Has this worked well until now? As we can see on the next slide, here is listed listed sectors, and here we see that it was very, very volatile. How was it in the private markets for the infra core space?
Yeah, absolutely. So the volatility in public equity markets is obviously widely felt, including in the infrastructure sector. You can see airports, MLPs, seaports, from a listed perspective, we're off 30% from early in the year to the trough at the end of Q1. So obviously quite a bit of volatility experienced. In general, within the private markets, there has been less volatility, and it goes a little bit to what we've experienced, but overall, a private asset should be valued on a discounted cash flow basis, long-term valuations, and consideration of a specific business plan and execution of that plan in terms of setting the overall valuation. So in general, what you've seen is lesser volatility into the marks of private infrastructure assets. And indeed, that should be predicated upon businesses that have had relatively limited or no interruption based on the COVID crisis. So indeed, the private approach to the asset class and indeed focusing on core assets enables you to avoid some of the public market volatility that you've seen in these markets. So, again, this is something that in terms of portfolio construction and how investors are thinking about the asset class has certainly influenced investor behavior around the world and balance between public allocations and private.
And how about the income and depreciation until now, and what do you expect it to be for this asset class?
Yeah, absolutely. So look, at the end of the day, this is the chart that should define a core asset or core portfolio. And it's similar to charts you might have seen for core real estate in the past. There is some possibility during a financial crisis or otherwise where there may be mark-to-market impact to the assets. The yield doesn't really change. So here we're using a compilation of MSCI data and JP Morgan asset management data. But this is the chart that you want to see and this type of a profile from your core infrastructure manager. Indeed, the income out of the assets should not be correlated to what's going on in your public equities. It should not be correlated to fixed income, which obviously the risk-free rates have dropped again, as Tilmann presented. So again, the value that you see in core infrastructure and what does it do for a portfolio is again supporting that consistent, predictable, uncorrelated income through the crisis. So certainly it would be our perspective that any manager, including ourselves, that is purporting to have a core portfolio should indeed be able to show a consistent, predictable income and consistently high cash margin from the overall portfolio.
And to ensure that, so what did you have to do during the crisis? What are like best practice portfolio management tools that you used to ensure that the portfolio as the result as we can see here on the slide?
Absolutely. So that's a good segue into the next segment here. And really for us, the ESG approach to an asset is really good business practices. And from our perspective, we synthesize, so it's easy to say, well, we have good ESG, but what does that mean? If you ask a CEO, how's your ESG? They might scratch their head and say, well, what element of ESG are you talking about? What does that mean? So we've tried to synthesize it down into really simple concepts. And so this is a protocol that we've had in place since before the crisis, but it turns out that these very good business practices tend to be very useful during a crisis. So from our perspective, we start with governance. We like to set a very good culture within businesses. And we find that the best way to start building that culture for success, for long-term preservation, for community service, et cetera, starts with safety. It's something that when you sit everybody down in the company and talk about, it's something that everybody rallies around. Everybody wants to be safe. Nobody wants to imperil their customers or their communities. Oftentimes the employees are the customers and communities. So those are the organizing principles. And really, so you could see the types of initiatives that could come out of those very simple frameworks. And clearly I could leave some of these for you to review individually. But at the end of the day, the safety response to COVID was paramount. And I should say as well that there's perhaps historically in the sector, there's been again, that assumption I mentioned earlier that you buy an infrastructure asset and the dividends will just show up every quarter. These are very involved businesses. They need to be actively managed and navigated through these cycles. So as a very concrete example, a utility to keep electric coming into my home during a pandemic might need to come into the house to do work on the wiring systems or deal with the water services, et cetera. Having the necessity of a utility to come into my home or to a customer's home during a pandemic means that there has to be very good safety training on social distancing and the safe way to be around customers and in customer homes. And so health and safety committees were focused and the boards were focused on this very early in the crisis period and before it became a true crisis. So we've been able to keep really the customers safe, keep employees safe in terms of health, keep essential services up and running, and moreover, be a good part of the community overall. So deferring non-payments was a policy we put in place very early to maintain. So if there was difficulty for customers paying, to suspend disconnections, again, being a good member of community during a challenging time. And furthermore, going a step further to support local communities. So for instance, some of our companies have a lot of extra safety equipment to deal with chemicals or otherwise. A lot of extra health and safety equipment was donated to healthcare workers, where obviously we had a shortage in the US and there were shortages elsewhere. We've also donated extra technology and laptops, et cetera, out of the companies to support distance learning in local communities. And again, so these behaviors, obviously these are things that any good, well-run business should do, but of particular importance to be a good member of the community when you're thinking about a core infrastructure investment. Obviously, these are sometimes very long-term investments. They deal with regulators and customer groups, et cetera. You have to be a good member of the community for the regulator to support you as you go through rate cases and otherwise. So again, this type of proactive, good community management of companies tends to be a very important way that we can move away from this notion that a company, an infrastructure asset, just pays a dividend every quarter, to this is a very actively managed business. It's an integral part of a community and has to be run as such. And indeed, that's how we've been able to be quite proactive in terms of managing the response to the crisis and continue to enjoy good operating margins and safe culture through the portfolio.
Thank you for all the insights. So now the last part about the outlook for this asset class. We hear a lot in the market, that asset class is pretty crowded. There are many people fighting for the trophy deals, and then it's too expensive. What's your view on that, and what kind of opportunities do you see in the market? Absolutely.
So I think first I'll start here on the demand side. So for those that have followed the sector at all or traveled to the United States, our infrastructure is in relatively poor shape. Not everybody could have Swiss trains, but I mean, we would take UK or German trains even here in the US. We're in not good shape in terms of this type of infrastructure. The amount of spending needed to support that, to upgrade, to weather harden, considering the increased incidence of storms and major weather events during climate change. All of these necessary investments are obviously titanic in terms of their scale. So trillions of dollars will be needed to invest. This is just, kind of simple cut through basic sectors, but there's just a tremendous amount of investment that needs to go to keep the infrastructure in a state of good repair. And if you total the entirety of private infrastructure investment, if you add it to, so consider all the private funds, and we've done some data analysis, which we could certainly share with folks if they're interested in follow-up. But yeah, if you add up all the private funds, you add up all the sovereign wealth funds, if you add up even all the public capitalization of the utility and transportation companies, you don't get up to these numbers. I mean, it's just a tremendous amount of capital. If you go through the capital spending, again, of those energy and utility companies. So there's a lot of capital to invest. But again, it is finding the right opportunities that differentiates different managers and the ability to take advantage of this investment necessity. So
in that context, we had a question from the audience asking how much of the planned infra investments has Trump achieved, and could Biden increase the infra investment even further? So what's the current situation there?
So there's a few things about US spending on infrastructure. So the first is that from a political standpoint, it is perhaps the only policy area in the 2016 presidential election where the parties were in complete agreement. There was perhaps the path to investing and supporting infrastructure was of debate, but the need for infrastructure investment was well agreed to on both sides of the aisle. That has translated to no infrastructure spending. So areas of agreement are the hardest to get good policy on. So there's really not been any movement on federal infrastructure policy in the US. We don't expect that in the near term. Granted, we'll see what happens after the election season. But notwithstanding that challenge, the more important point probably for the US is that infrastructure spending is much more directed at the state level. Some would say that we have 50 countries that also, so you have individual regulators at the state or even more local levels. And there's significant fragmentation of assets within the country. So indeed, where you really need to look to understand where where fiscal spending is going to support infrastructure, it's really from the state houses. And within the states, there's a very divergent view in terms of how we incorporate private infrastructure spending versus state-led spending, et cetera. So it really is, for those that are investing in the US, a question of where to invest, what the regulatory frameworks look in that particular area. And again, that's for those that are interested in following, really the place to pay the most attention is the states.
And thank you for that. Then moving on to the next slide. So what is the outlook for the risk premium for the infra core asset class? we have seen like the bonds, as mentioned by Tilmann, are going down in just one way. Is it also the case for infracore, and but will it still be enough pickup in the future, do you think?
So this is the interesting question about core infrastructure and the test. So while clear that there's been a growing appetite and higher bid for core infrastructure assets over the last cycle, and here we're going back 20 years on this chart. What's interesting about this is that the premium for equity return and equity discount rate on core infrastructure assets has maintained a relatively stable spread over the risk-free rates in those markets. So obviously we're showing some of the OECD risk-free rates, and we continue to roll this forward over time. But what's remarkable is that there's been a 600-700 basis point spread between that infrastructure return and the risk-free rate. So we continue to expect that there is kind of mid to high single-digit returns available in core infrastructure utility type investments. But if we do, and again, Tilmann raised the prospect of maybe some inflation over the midterm, perhaps that correlates to rising interest rates, given everything we've seen on the monetary and fiscal policy side. If that does happen, we would generally expect a pickup in the allowed returns. If you imagine the capital structure for that business or for that utility, the equity would certainly have to return more than the debt, or there to have the proper risk return profile. So we would expect that regulators in the event of a rising inflation or rising interest rate environment would need to allow for equity risk premiums to increase reflective of that interest rate environment. So again, this is something that we've seen quite steady over time. We're continuing to see utility and opportunities trade in this window or at this spread. And so we expect the ability to generate core-like returns in these assets, even if there is greater participation in the asset class by investors around the world, given the underlying conditions we've been discussing.
Thank you. So then moving on to the opportunities, what would you say are the main opportunities and where for the future? Where do you source your opportunities? Is it like by corporates, with the public? Where are the main opportunities? That will be the last question before we then jump in the Q&A as we got a couple of questions.
Yeah, absolutely. So my next slide looks like I stole it from Tilmann. From the market strategy group, but actually bears pretty importantly in terms of how we see the market opportunity set from a core perspective. So if we could go down to slide 28. This is just some general picture of the recession. I guess we've lost the slides, but while they're coming back, the overall market environment that allows for continued participation from our perspective is the general increase in debt outstanding over time among large corporates. So I think there's a very good temptation to imagine that everybody would have the capital available to take care of the opportunities and crisis that were missed during the GFC. So a lot of private equity funds wish they had more capital available in 2009 to take advantage of opportunities. This spring, the opportunity set for those types of opportunities was about 2 weeks. So the monetary and fiscal interventions came quite swiftly, as Tilmann described. There was stabilization in terms of overall markets, certainly asset classes that had immediate strain on balance sheet and liquidity, obviously in the hospitality sector, et cetera. But notwithstanding, the credit event is not over, and indeed it's starting to pick up. So rating agencies are going to be quite critical of companies looking at overall income and debt coverage ratios, investment grade rankings. And for those large corporates, utilities, et cetera, that made a mistake in the last cycle or a little over leveraged, as you see from the top right of the chart. There could be pressure to divest assets that, again, are not in distress, but can be divested as quality assets that need to be divested to support overall liquidity and investment grade characteristics of the business. So that's an area and opportunity set that we've seen a noticeable pickup in recent weeks. And we anticipate a pretty rich opportunity in terms of deal flow over the next couple of quarters as all this activity shakes out. But indeed, the interesting part of this type of an opportunity set, and for a core open-ended strategy where we're trying to buy assets over the very long term, sellers, particularly from corporates, are a little bit more hesitant to sell to short-term investors, closed strategies. This is an area where sometimes a private equity company will swoop in, get a great deal, and sell it for 3 times their money a couple of years later and make the corporation that sold it look terrible. So there's a bit of a desire from the selling entities to find long-term, really strategic-like investors into the assets. And there's also a community element and regulatory element to this, that selling to an investor that is able to manage well on an ESG basis, be a credible buyer and manager of the asset when they acquire it, is important from a reputation standpoint for the seller. So again, these are the types of opportunities where a long-term investor, a strategic investor, can be quite, I guess, have a good competitive advantage in these types of scenarios. So we think that these assets will be available at not distressed valuations. These are reluctant sellers getting rid of a good asset. Good assets will sell for fair value. But again, they might not otherwise have been for sale, but for the credit conditions of the parent. So we think that's going to be an opportunity set that materializes over the next half year or so, and something that we will be particularly focused on. But again, sector by sector, and I know there were some questions about the valuations in different subsectors within infrastructure. It will vary. So there are areas of the market that have been more competitive than others. There is a lot of dry powder within the private markets, which could result in bid for certain types of assets. So as a particular example, we've seen very aggressive valuations through the cycle in US renewables. There's been particularly solar, which are kind of simple operating businesses, et cetera. So you do have to look around markets, and there's different things going on in different subsectors of infrastructure. But generally speaking, there are obviously a lot of different strategies out there, and those that have different competencies or capabilities in terms of different sectors or approaches.
Great. So thank you very much, Dan, for those very good information. Just to conclude, we just had 2 questions for Tilmann, just in 1 minute, if possible, to answer. It's a pretty big question, too big question, but how big are the risks, or what are the biggest risks of a second wave for the financial markets? And also, if you can have a little view on the risk of Brexit as well, before we conclude.
I think two tricky questions indeed. I think we still have to acknowledge that, of course, there's a risk that a further deterioration on the health front might lead to further lockdowns in the economy. I think we have seen recently this example now with Israel, that have to re-implement harsher lockdown measures. So this stays a risk going forward. Although we must acknowledge that it seems that the world has at least started to handle better the crisis regarding treatment, regarding kind of avoiding full lockdowns of the economy, do locally or implement locally measures. So from that point of view, it is still a risk there. It's very hard to predict since the solution is not in our hands. It's on the hands of the medicine and the medical stuff. So from that point of view, it stays a risk there. So from that point of view, for us, it's still one of the reasons to have kind of a balanced approach to risk in our portfolios. Regarding the Brexit risks, there's indeed kind of a level up in the in the exchange and in the heated exchange between London and Brussels. And indeed, kind of the hard Brexit risk increased recently. In our view, it's even if the worst case comes sets in with a hard Brexit, we still think that there will be kind of a transition phase agreed between Brussels and London to avoid this kind of regulatory and economic cliff that might then occur at January 1st. So from that point of view, it is a risk, and it's probably more than a risk that is also very highly reflected in the British pound. So from that point of view, we are still relatively cautious regarding the pound.
Thank you very much, Tilmann, for the explanation. So we have a couple of more questions, but unfortunately we are already out of time, but we will make sure that we will answer all the questions after the webinar. Here as well, my team members also, that you can contact at any time if you have any question on what Tilmann just said or on the InfraCore space, and we will be happy to answer all the questions. And now we'll hand over to Sheila for some concluding remarks.
Thank you. Thank you very much, Richard, Daniel, and Tilmann, for a very interesting presentation. And we're hoping that next time it will be in person here in Zurich, that the situation and events allow that. But thank you very much for taking your time now to join us here in Switzerland virtually. And we very much appreciate your presentation. Thank you again.